What's happening right now in the silver market is unlike anything most people have seen in their lifetimes. And if you have retirement savings sitting in a traditional account right now, a 401k, an IRA, anything tied to paper assets, what I'm about to share with you may be the most important financial information you've ever heard. Not because I'm trying to alarm you for no reason, but because the data is sitting right there in plain sight, and almost nobody is talking about it in the mainstream. Let me ask you something. You know that feeling you get when you're watching a storm roll in on the horizon? When you can see the dark clouds gathering, when the temperature drops just a little, when something in your gut tells you it's time to get inside? That's where we are right now with the silver market. Except this isn't a summer storm. This is a confluence of forces that hasn't existed at the same time, all pointed in the same direction ever before in modern history. So let's dig in. Let's talk about what's actually happening, why it's happening now, and why the window to act, the real window, not the one the financial media will eventually cover when it's already too late, why that window may be closing faster than anyone realizes. Silver is right now trading above $70 an ounce. Think about that for a moment. Because if you told someone that a decade ago, they would have called you a lunatic. But here's what's even more extraordinary than the price itself. It's the story behind why it got there. And more importantly, why the forces pushing it higher are not temporary. They are structural, they are permanent, and they are accelerating. Let's start with the supply side, because this is where the story gets genuinely alarming. According to the latest World Silver Survey published by the Silver Institute and produced by metals research firm Metals Focus, the silver market has been running a structural deficit, meaning demand exceeds what miners can pull out of the ground every single year for several years running. When you look at the actual numbers, global mined silver supply comes in at around 846 million ounces annually, and total silver demand over 1.1 billion ounces. You do that math, and you're staring at a gap of nearly 300 million ounces every single year. Every single year. That gap has to come from somewhere, from recycled silver, from existing stockpiles, from paper positions that eventually need physical settlement. And those stockpiles are not infinite. They are finite, they are being drawn down, and the drawdown is accelerating. Now, you might be thinking, well, hasn't silver always had some kind of demand? Yes, but here's where this moment in history is categorically different from anything that came before it. Because the industrial demand picture for silver has fundamentally transformed in a way that is going to prove impossible to reverse. Think about the world you're living in right now. Every solar panel that goes up on a rooftop, on a utility scale farm, across millions of acres of land being converted to renewable energy generation. Every single one of those panels requires silver. Not copper, not aluminum, silver. Because silver is the most electrically conductive metal on Earth. And when you're trying to convert photons from the sun into usable electricity at maximum efficiency, there is no substitute. The photovoltaic sector alone accounts for nearly 30% of all industrial silver demand. And the build-out isn't slowing down, it's ramping up. But that's just the beginning. Now add electric vehicles. According to research commissioned by Oxford Economics for the Silver Institute, electric vehicles use somewhere between 67 and 79% more silver than a traditional internal combustion engine vehicle. Every electric car that rolls off an assembly line requires silver in its battery management systems, its charging interface, its countless electrical connections. And that's before you even account for the charging infrastructure. Every charging station is silver intensive as well. As the EV transition accelerates globally, as governments mandate the phase out of combustion engines, that demand doesn't flatten, it compounds. And then, and this is the piece that I think most people genuinely haven't processed yet, there's artificial intelligence. The AI revolution is not a future event, it's happening right now, at a speed that would have seemed impossible just a few years ago. And what does AI require? Processing power, massive, industrial-scale computing infrastructure, data centers, cooling systems, high-speed networks. Silver's superior electrical and thermal conductivity, the same properties that make it essential for solar panels, make it irreplaceable in the infrastructure that powers AI. Oxford Economics has projected that global data center electricity needs could double by the end of this decade as AI adoption continues its exponential expansion. Every watt of that electricity flows through silver-bearing components. And this is a brand new demand driver that didn't exist at scale even a few years ago. It is being piled on top of all the other demand drivers simultaneously. Now, pause for 1 second, because if you're sitting there with retirement savings and you want to understand the protection strategies that thousands of American retirees are already using right now to shield their wealth, I've put together a free guide that walks you through exactly how this works. It's in the description below. Check it out, because what I'm going to keep explaining is only going to make the urgency more clear. Back to the supply-demand picture. You now have three seismic industrial demand drivers: solar, electric vehicles, and AI, all consuming silver at unprecedented rates, all growing simultaneously, and all competing for a supply that cannot keep pace. But here's the thing about silver that most people don't fully appreciate. Unlike gold, which sits in vaults and gets recycled endlessly, silver gets consumed. It gets burned up. It gets embedded in solar panels and electronics and batteries, where recovering it is extremely difficult and often not economically viable. Which means every ounce that goes into an industrial application is, for practical purposes, gone, permanently removed from the available supply. The Silver Institute's own data shows recycling hit a 13-year high, a record, trying to compensate for the shortage, and it still wasn't enough to close the gap. Think about what that means. The market is already straining every mechanism it has to bring more silver to market, and it still cannot meet demand. Now, let me take you back in time for a moment, because history has a way of rhyming when you're paying attention. Cast your mind back to 1971. President Nixon stands before the American public and announces that the United States will no longer honor the conversion of dollars to gold. Just like that, the Bretton Woods system, the framework that had anchored global currencies to the dollar and the dollar to gold since 1944, was torn apart. That decision unleashed forces that took years to fully manifest, but when they did, they were spectacular. Gold went from $35 an ounce to over $800. Silver went from under $2 an ounce to $50, a gain of more than 2,400% in less than a decade. The people who saw what that monetary shift meant, who understood that when you remove the anchor from a currency, the purchasing power of that currency deteriorates, those people preserved and grew their wealth, while everyone else watched their savings get eaten alive by inflation. Then there's 1980, the Hunt brothers. For those who don't know this story, it is one of the most dramatic chapters in the history of financial markets. Nelson and William Hunt, two Texas oil billionaires, became convinced that the United States was on a path of monetary destruction after Nixon closed the gold window. They began systematically accumulating physical silver on a massive scale, ultimately controlling a position that represented a staggering portion of the world's above-ground silver supply. As their holdings grew, the price exploded, from single digits to $50 an ounce in a matter of months. Markets were in chaos. COMEX, the commodities exchange where silver futures are traded, changed its rules midstream to specifically prevent further accumulation. Silver collapsed in what became known as Silver Thursday. The Hunts lost billions. But here's the part that gets written out of most financial history. They were right about the monetary thesis. They were right that silver was a powerful hedge against dollar debasement. They just concentrated too heavily, borrowed too much, and gave the exchange operators a reason to change the rules. What's happening today is entirely different in character. This is not one or two large actors. This is the entire global industrial complex. Solar manufacturers in China, automakers in Germany, chip foundries in Taiwan, AI server farms in Texas, all needing silver, all competing for the same limited supply, all at the same time. You can't change the rules on supply and demand the way you can change margin requirements on a futures exchange. And then add the monetary picture, because the geopolitical and financial architecture that has governed the world since 1971 is visibly, undeniably fracturing. The BRICS nations, Brazil, Russia, India, China, South Africa, and a growing list of others, have been actively, deliberately working to reduce their dependence on the US dollar for international trade and reserves. Central banks globally have been accumulating gold at a pace not seen in decades. This isn't speculation. This is documented fact. These nations watched what happened when the United States weaponized the dollar-based financial system through sanctions, and they drew a conclusion. Holding reserves in an asset that a foreign government can freeze with a phone call is a vulnerability they can no longer afford. So they are systematically shifting into assets that nobody can freeze, assets that exist outside the dollar system, hard assets, physical assets, gold, and silver. The de-dollarization story is often dismissed in American financial media, and that's understandable because it's uncomfortable. The idea that the dollar's reserve status, that bedrock assumption underlying virtually every asset price, every retirement calculation, every pension fund projection in America, could be eroding in real time is genuinely difficult to process. But dismissing it doesn't make it not true, and the people who understand what's happening are quietly making moves. The question is whether you're going to be one of those people. Let me tell you what this looks like at the market structure level, because it's important. There's a fundamental distinction between paper silver and physical silver that most people never think about. COMEX, the commodities exchange where silver futures are traded, has a registered inventory, meaning the physical silver that is actually available for delivery against futures contracts. That inventory has been drawn down dramatically as institutional players, industrialists, and sovereign buyers have demanded delivery of actual metal rather than paper promises. Meanwhile, the ratio of paper claims to physical silver is extraordinary. For every ounce of real silver sitting in registered vaults, there are many, many more paper contracts claiming that silver. That is a structure that is stable until it suddenly isn't. When holders of paper contracts start demanding physical delivery en masse, the math doesn't work, and that is when prices do not move gradually. They move violently. This is where the gold to silver ratio becomes a critical piece of the puzzle. Historically, over thousands of years of recorded human exchange, silver has traded at roughly a 15 to 1 or 16 to 1 ratio to gold. That is the ratio that existed in the natural world, roughly 15 ounces of silver mined for every 1 ounce of gold. Today, that ratio sits near 60 to 1, 60 ounces of silver to buy 1 ounce of gold. That is an extraordinary historical anomaly. That is the market telling you that one of these metals is radically undervalued relative to the other. When that ratio reverts, and ratios always revert eventually, the move in silver will be parabolic, because it's not just catching up to where it should be relative to its own history, it's catching up while simultaneously being consumed by the most significant industrial transformation in modern history. And here's what I want you to sit with for a moment. The people who are going to look back at this period and wish they had acted, they're not going to be people who didn't have access to this information. This information is available. The Silver Institute publishes it publicly. Oxford Economics publishes it. The data is right there. The people who will look back and wish they had acted are going to be the people who heard it, who perhaps even understood it, and then did nothing, because taking action felt complicated, or because they assumed they'd get to it later, or because they trusted that the systems that had protected their savings so far would continue to protect them. Here's the hard truth about that assumption. The systems that protected savings in the past, diversified stock portfolios, bonds, bank deposits, traditional IRAs loaded with paper assets, those systems were designed for and tested in a world where the dollar was unquestioned, where interest rates were predictable, where geopolitical stability was the baseline assumption. We are no longer living in that world. The stock market has become increasingly disconnected from economic reality, driven by institutional flows, algorithmic trading, and momentum rather than by the underlying value of businesses. Bonds have been destroyed by inflationary pressures. And bank deposits? The purchasing power of every dollar sitting in a savings account earning nothing while inflation eats away at it represents a slow-motion loss that most people don't viscerally feel until it's too late. Silver is different in a fundamentally important way. Silver cannot default. Silver cannot be printed. Silver cannot be sanctioned or frozen by a foreign government. It is a physical object, a tangible asset, a piece of the real world that has been recognized as a store of value by every civilization in human history. It sat at the monetary foundation of the United States itself for most of this nation's history. And now, at precisely the moment when monetary uncertainty is at its highest, when industrial demand is at its greatest, when supply deficits are structural and growing, silver has also been formally designated by the United States government as a critical mineral. That designation is not ceremonial. It has real implications for how the metal is viewed at the highest levels of government and finance. Now I want to speak directly to those of you who have retirement savings, whether in a 401k, a traditional IRA, a Roth, or some other qualified account. Because there is something critically important that many people with these accounts don't realize. You may not have to liquidate those accounts and take a tax hit to get exposure to physical silver. There are IRS-approved structures, self-directed IRAs that allow you to hold physical precious metals directly within your retirement account. Your existing retirement savings can be rolled over or transferred into one of these accounts without creating a taxable event. And within that account, you can hold actual silver, physical silver bars and coins meeting the required purity standards, stored in an IRS approved depository. Real, tangible metal, not a paper promise, not an ETF whose actual metal holdings are perpetually in question, not a futures contract. Physical silver, held in your name, in your retirement account. For those of you sitting on $100,000 or more in retirement savings who want to understand exactly how this process works, step by step, what the costs are, how the rollover is done, what the IRS requirements look like, what custodians to work with, I've put together a resource that walks through all of that. It's accessible right through the link in the description. This is the kind of protection that the smartest money in the room is quietly moving toward right now. And unlike most financial moves, this one doesn't require you to be a market timing genius. It doesn't require you to predict the exact top or bottom of anything. It requires you to simply recognize the structural reality of what's happening and position yourself accordingly. Because here's what I keep coming back to when I think about the retirees and pre-retirees who have been the most devastated by previous financial crises, by 2008, by inflationary periods, by market collapses that wiped out years of savings in months. The thing they all had in common wasn't a lack of wealth. Many of them had significant savings. What they had in common was concentration. They were concentrated in the very assets that were most vulnerable to the specific crisis that hit them. Their 401k was stocks. Their stocks crashed. Or their savings were in the bank, earning nothing while inflation destroyed purchasing power. Or they owned bonds that got hammered as rates moved against them. In every case, the crisis came from the direction nobody expected, through the door nobody was watching. Right now, there is a door that most retirement investors are not watching. That door is the dollar. That door is paper assets. That door is the assumption that the monetary and geopolitical stability of the past several decades will continue uninterrupted. And while I cannot tell you with certainty exactly when that door swings open, I can tell you with high confidence that the pressures building behind it are unlike anything we have seen in living memory. The silver market already crossed $50 per ounce for the first time since 1980. You read that correctly. The price level that it took the Hunt brothers' entire operation, billions of dollars in accumulated positions, and a buying frenzy that nearly broke the entire futures market to reach in 1980, silver got back there organically, driven by real industrial demand and monetary flight to safety, without any single entity manipulating the market. And it didn't stop there. When you look at what happened after silver broke $50, the last time the world was in a moment of comparable monetary crisis, in 1979 and 1980, and you understand that we are now confronting monetary debasement, a fracturing of dollar hegemony, the largest structural supply deficit in the silver market's modern history, and simultaneously a once-in-a-generation industrial demand transformation driven by the electrification of the global economy, you start to understand the magnitude of what may be coming. I've been studying precious metals markets for a long time. I've watched bull markets and bear markets, corrections and blow-offs, periods of complacency, and periods of panic. And I will tell you, the configuration of forces in the silver market right now is extraordinary. Not in a theoretical or speculative sense. In a data-driven, supply and demand, the math literally doesn't work sense. The deficit is real. The industrial demand drivers are real. The monetary uncertainty is real. The paper-to-physical discrepancy is real. And the historical precedent for what happens when all of these forces converge is unmistakable. The question you have to answer for yourself is a simple one, not a complicated financial question, a simple human question. The question is, when the evidence is this clear, when the structural case is this compelling, when the window to act is right in front of you, are you going to act, or are you going to wait until everyone else has figured it out? Because here's the brutal reality of how these markets work. The price discovery doesn't happen gradually and politely. The silver market in particular, which is relatively small compared to global financial markets, has a history of moving with extraordinary speed once a critical threshold is crossed. When institutional money starts to rotate, when the paper-to-physical reckoning accelerates, when retail demand surges as the narrative finally breaks into the mainstream, the move happens faster than most people can react. The people who benefit are the people who were already positioned. The people who say, I should have done something about this, are the people who saw it coming and waited. You stay with this video, which tells me you're not someone who scrolls past information that matters. You're someone who takes their financial future seriously. So let me leave you with this. Everything I've described tonight, the structural supply deficit, the industrial demand transformation, the monetary debasement, the paper to physical discrepancy, the historical parallels, none of it is secret. It's all publicly available. The Silver Institute publishes the data. Oxford Economics quantifies it. The price action confirms it. What is scarce is not the information. What is scarce is the willingness to act on it before the mainstream catches up. If you're watching this and you have retirement savings, particularly if you have $100,000 or more in any retirement account, I want to invite you to take one step, one simple step. In the description below, there's a link to a free guide on how thousands of American retirees are already using physical precious metals within their retirement accounts to protect their hard-earned wealth from exactly the forces we've been discussing tonight: market instability, dollar debasement, geopolitical risk, inflation, systemic financial pressure of a kind that traditional paper assets are not equipped to withstand. And for those of you who watched all the way to the end of this video, I want you to know something exclusive. If you reach out through that link and mention that you watched to the very end, we will set you up with a complimentary one-on-one educational web conference. No obligation, no pressure, just a private session with a specialist who can walk you through exactly how this works for your specific situation. This is available to American retirees with $100,000 or more in any retirement account, and it is not something we advertise widely. It is for the people who cared enough to do their homework, for the people who watched to the end. The storm on the horizon is real. The data confirms it. The history supports it. And the window to act wisely is open right now. Make the most of it.